Well, hi, everyone, and welcome to the Buffett and Beyond Research stock, or I should say stocks of the week. And we're going over GE Vernova, and we're going over the new GE, which is now the GE Aerospace, and we're going over GE Health. And boy, what a difference this company has gone through, or what a change it has gone through over the past couple of years. And we went over GE Vernova just, 2 months ago, and at the time we said it's up. What's up? It's 275% over the past 2 years. Well, folks, it's up even more than that because they just came out with earnings the other day, and this stock is shooting to the moon. Our question is, which we will answer later on in the week, not so much here, but will we replace some of the stocks in our growth portfolio with GE Vernova? We're going to add it to the portfolio. The thing is, it's going to replace one or two of the stocks. And also GE Aerospace, which is called just GE now, but the full name is GE Aerospace. So GE has cut out a lot of what it was doing, combined, spun off, and let's go into it. Now, that presents a problem for us because we calculate the clean surplus methodology. And we'll get into that as we go along. But first, remember, if you want to live on this beach like Jimmy Buffett once did, then you've got to learn how to invest even better than Warren Buffett does now. And let's go to GE Vernova. And as I said, we went over this a couple of months ago. The company provides products and services that generate, transfer, orchestrate, convert, store electricity with the aim of reducing carbon emission. And management claims that approximately 25% of the world's electricity is generating using its technology and equipment. Has three business segments: power and hydro, gas, nuclear, and wind and electrification. Now, wind is dying down, and no pun intended there, folks. Wind is dying down, but their gas turbines, their gas generators are really doing something, and they just sold a bunch of them, a huge number of those gas turbines at $50 million each over in China. So yeah, they're doing something with this company. And folks, it's not that GE is new in this area. They have been around forever. I've seen GE turbines on old World War II merchant ships, the GE steam turbines. So they've been around a long time. And just because they're a spinoff doesn't mean they're a new company. They've been doing this for a very long time, and the world loves it because AI needs power. Yes, they're building power stations all around the world. And there are some places in the world, a lot of places in the world, as a matter of fact, that don't have the electrification power it needs for its AI systems. And so that's where those gas turbines come in, because you just stick a gas turbine out there in the middle of the desert, and bam, you've got all the electricity that you need. Okay, now, GE Aerospace. GE spun off GE Healthcare in 2023. Then it spun off GE Vernova in 2024. So what's left? Well, GE. So what remains under the General Electric flag is a global aerospace propulsion services and systems leader right in here, with an installed base of approximately 45,000 commercial and 25,000 military aircraft engines, has 53,000 employees. And this has been a big part of GE since forever. Remember Pratt Whitney? Yeah, well, that's stuck in here somewhere, folks, right? Not in healthcare, but it's certainly in GE Aerospace, which is, if you look up GE now, it is GE Aerospace. So GE got rid of a lot of the things, spun them off, discontinued some of the projects they were into, because about 20 years ago, GE had to be in your portfolio. It was in so many industries, the joke was going around that GE is its own mutual fund, because it had so many different segments. Well, it finally started dragging it down, and we got rid of it almost 20 years ago because the clean surplus return on equity was dropping off. In other words, they were still making money, but they were making money at a decelerating rate. In other words, their growth rate was slowing down, and therefore we had other stocks that replaced GE. Now all of a sudden it's come back, but what is it really doing? Well, now it has defined itself. So we have GE Vernova, we have GE Aerospace, we also have one more. But first, and now it is GE Healthcare, we'll get into that in a second. I want to go over, this is the traditional accounting return on equity. The traditional accounting ROE, there should be an R in there, or traditional accounting owner's equity. So the clean surplus owner's equity is, look at the difference in this. This is almost 6 times different than the traditional accounting ROE. So some of you out there are trying to find a way to use AI, artificial intelligence, in order to do what I'm doing here. The problem is that there is more than one way to calculate this owner's equity in the beginning, because it's the beginning numbers that count so very, very much. And there is more than one way to do it. And you have to experiment in order to find out which way is the best. So AI is not quite there yet, folks. Will it ever become there? We'll see. We have to make up the rules. And some of you are in contact with me, and we'll work on it. So it might be easier. I don't know. It's still the data that you put into it that's going to come out. So if it's garbage in, it's garbage out. You know the story. So anyway, I just want to show you here that the traditional accounting return owner's equity or book value is totally different than the clean surplus equity, owner's equity, or book value. Owner's equity is synonymous with book value. But this is the old GE. Look how bad it got. It used to be 20% year after year after year after year. It was so constant. It was absolutely amazing. Then it started dropping down to 19%, 18%, 17%, and look where it is today. But this was the old GE. Now, let's get into it. So we go to GE Vernova. We here at Buffett and Beyond had to come up with this beginning book value. This is a new company. And one way that I mentioned there's several ways of coming up with that beginning owner's equity book value. Whichever way you use to come up with it, you test it by looking at the clean surplus ROE, because the net income or the earnings, the clean surplus earnings, we're looking at those. They're going up. That's nice. At what rate are they going up? Well, they're going up at a nice rate. We're above 20% now. So that's how we know that we may have been a little wrong on this, but not very at all, because it takes several years to start breaking this in to see if we are correct, on a correct path. We could estimate too low. This could be too high, but as long as it's rising, we know we've got something here. So that's GE Vernova. Now let's look at GE Aerospace. And this was the problem here, folks, because let's go here to healthcare, because we figured out healthcare, and that was hard to determine. This is why it's in red here, because this is, I don't want to say it's a guess, but it's a calculated guess. And we're looking at the clean surplus ROE, and it's below 20%. And since it's fairly constant, looking 15, 16, 17%, we know we probably have a pretty good starting owner's equity. Now let's go back to GE Aerospace, which is now GE. So we had to come up with a number in here, and I'll show you why. We're going to see a chart here in a minute, why we think this is correct. Because see how even this return on equity is? It's over 20. And it's staying right around 23%, isn't it? So that means that we're on to something here. But again, it's this beginning number. So people are saying, why are we in GE Aerospace? Or why not are we in GE Aerospace? Or why not in health, etc., etc.? So this is the question that you've all been throwing at me, and a lot of you have asked it. And we've been looking at GE Vernova for, a couple of months now. And folks, we should have stopped looking and just bought it, because the earnings that came out the other day are just, everybody wants their power grids updated. They want their power generation increased. Let's go more. Here we went over GE Healthcare. Now, let's see a 1-year chart of all three stocks. First of all, black line is the S&P 500. GE Healthcare down here. Now remember, GE Healthcare below the S&P 500, we gave it an ROE that was less than 20%. 20% is what it fits into our parameters of getting into our growth portfolio. So the GE Healthcare, let's go back to that right there. GE Healthcare is below our 20%, but it's above average, and it's staying above average. So when we go back here, we're thinking that it should be above this black line. However, it's not. Why? Because healthcare is in the same doldrums as housing is right now. So anyway, it might be a good stock going into the future, because if we're correct on this, then it should be a better than average stock. But we want to see 20% in here to get into our growth portfolio. Okay, back here. Now, this next line in here is GE Aerospace, the new GE, or what's left of GE after it stopped some of the areas that it was in and spun off this blue line up here which is GE Vernova. Look at this rise up here, folks. I mean, this is absolutely amazing. So we have two stocks that we're looking at now, and even GE Healthcare. Once healthcare gets its act straightened out, it might be a better than average stock. But will it get into our growth portfolio? Well, GE Vernova up here and GE Aerospace are both outperforming the S&P 500, so we know we're right about their beginning owner's equity. Now, how long did it take us to figure out that beginning owner's equity? A very long time, folks. I mean, we're talking serious man hours and woman hours put into that, coming up with these numbers. So let's go to 2 years, and 2 years, here we go. GE Vernova, look up here, and what's up 200%? The GE Aerospace. And the market is up, about 40% over the past 2 years, doing very, very well. But healthcare is down here around zero. So healthcare hasn't been performing. The entire industry has not been performing. But look at this blue line. Remember, GE Vernova just got into this last year. It was just spun off last year, where the General Electric has been around forever, but now that it has taken the weight out of itself and got its act together and is now just in aerospace and defense, which is pretty good under this administration, we see it up 200%, with the market up about 40%. And of course, here is GE Vernova, 375%, 380% over 2 years. Absolutely amazing, folks. But and of course the question is, do we get into this stock after it's had this kind of rise like that? That's always the question, isn't it? And sometimes you just have to close your eyes and do it. And we usually wait till the end of the year. So our big question is, which we'll go over this week during our daily letters, the two stocks that we're thinking about replacing, well, we have problems with them because one of them is in an industry that is in the doldrums, and the other one is just not performing very well this year at all, but the numbers are still good. So we have a problem, which we'll go over this week. So, folks, we're trying to sort out a problem here. Yeah, I wish we all had problems like that, right? We're looking at which of the best stocks do we want to pick, which are the best of the best stocks, exactly. So remember, you go out. We've had a good week this week, a very good week, and you go out, enjoy yourself, take your mind off the market, be with your family, go for a walk, get some fresh air, because, folks, we'll be right back here in a couple of days. Stay safe, and we'll see you then.